Okay, so if you're a business exporting goods into the European Union, listen up. The entire rulebook has just been rewritten. Today, we're going to break down a really practical framework for dealing with this new world, a world where carbon isn't just some number on a sustainability report anymore, it's a core financial risk to your business. Let's dive in. This quote right here, it just nails it. The EU's Carbon Border Adjustment Mechanism, CBAM, it's moved way past being a simple reporting exercise. Now, it's a direct financial cost. And believe me, that one little shift, it changes absolutely everything for exporters.
The old question was pretty simple, right? It was just, do we understand our emissions? But the new questions, they are way more urgent and a whole lot more complex. We're not just talking about sustainability anymore. We're talking about financial exposure, market volatility, and data integrity. This is a whole new ballgame.
So, to answer those tough questions, you need a solid plan. And it all starts with our first pillar, actually quantifying the financial hit. We're talking about taking carbon out of the clouds of theory and seeing how it impacts your company's bottom line.
And here is the most crucial point, so don't miss this. You cannot figure this out by looking at some corporate-wide average from a fancy dashboard. You have to get granular. You have to go product by product. Why? Well, because what so many companies are finding out is that their highest volume, lowest margin products, those are often the ones carrying the most hidden carbon risk. And here's the metric that tells you exactly what's going on, the CBAM margin impact percentage. To put it simply, this formula just calculates how much of a specific product's profit margin is going to get eaten up by this carbon tax. It's a direct measure of that product's economic fragility. And once you have that number, you can use a simple scoring system like this one to start sorting your products. Look, if the CBAM cost is chewing up more than 15% of a product's margin, you are officially in the high-risk zone. This table immediately tells you which products need your attention like yesterday.
But hold on, it's not a one-and-done calculation. That's just a snapshot. Your financial exposure isn't some fixed number because it's directly tied to the price of carbon on the EU's emissions trading system, the ETS, and that price can be incredibly volatile. You have to start treating carbon price like any other financial risk variable, not some static number.
All right, let's make this real. Let's run a quick stress test. Imagine you've got this product. We'll call it Product A. Right now, it's got a nice, healthy 18% profit margin based on today's carbon price. Everything looks great, right? Okay, but watch this. What happens if the carbon price just sees a moderate jump, say 25%? All of a sudden, that same product's margin shrinks down to 14%. Now you can start to feel the squeeze. The risk is becoming very, very real. And now for the severe scenario, a 50% price spike. Well, that healthy margin gets absolutely crushed, down to just 8%. This kind of volatility directly hammers your EBITDA predictability, your earnings. And you know who cares about inconsistent earnings? Your investors and your board. Deeply. And that brings us perfectly to our second pillar. Because, let's be honest, all those financial models we just talked about, they are completely worthless if the data you're feeding them is garbage. This is where we start mapping the hidden risks that are lurking deep inside your supply chain. Think about it. Your exposure calculations are only as good as the emissions data you're getting from your suppliers. So you have to ask, are they just giving you estimates? Or is their data transparent? Is it aligned with the EU's own methodology? Has a third party actually verified it? Scoring your suppliers on these factors is absolutely critical. And this is where it gets really interesting. We overlay financial exposure with data reliability, and what it reveals is the one place you do not want to be, that top left quadrant, a high-exposure product that's relying on unverified, low-quality data from a supplier. That, my friends, is a ticking time bomb. And the risk isn't just financial, not just numbers on a spreadsheet. Poor data management has real-world consequences. If the data in your CBAM filings doesn't perfectly match your customs entries, guess what? Your goods can literally be held at the border, creating massive, costly delays and blowing up your whole supply chain. And the last piece of this puzzle is remembering that risk looks different depending on where you are. The country of origin really matters. A country adjustment factor helps you account for things like the local energy grid's carbon intensity or how stable the government is, adding a much-needed layer of geopolitical realism to your whole model. Okay, so you've quantified the financial hit, you've mapped your supply chain risks. Now for the final pillar. This is the payoff. This is where we bring it all together and turn all that data and analysis into a clear strategic plan that your leadership can actually understand and use. This quote says everything you need to know. If you want executives to act, you can't just talk about tons of CO2. You've got to translate it into the one language they truly understand, the language of margin, EBITDA, and revenue. That's when carbon stops being an abstract idea and becomes real to the business.
And this is exactly how you do it. A clean, high-level dashboard for the board. We're not talking hundreds of data points. We're talking structured clarity. It shows the total financial exposure in euros, pinpoints the high-risk products, and even has a heat map for supplier reliability. This is what allows for quick, smart decision-making.
Now, that dashboard isn't just for show. It plugs directly into a clear action plan. By tiering your risks, you create a structured response. See? The critical risks get immediate executive attention, while the manageable ones just get an annual review. This whole approach gets you out of panic mode and focuses your resources right where they're needed most.
So let's just zoom out for a second. When you put these three pillars together, the outcome isn't just about managing some new, annoying regulatory burden. No. It's about building a stronger, more resilient, and ultimately a more competitive business for the future.
What this framework really lets you do is make a massive strategic shift. You move away from that reactive check-the-box question of, are we compliant, to the much more proactive strategic question, how resilient is our entire EU trade model? And that is a way more powerful conversation to be having in the boardroom.
And that really brings us to the ultimate takeaway here. In this new era of carbon-adjusted trade, the companies that can see, measure, and manage these new risks, those are the ones that are going to win. Risk visibility isn't just a defensive move anymore. It is a source of true competitive advantage.
So really, it all boils down to this one simple question. Carbon-adjusted trade is here. It's a structural reality. It will impact your business. The only choice you have left is whether you are going to be the one to measure and manage it, or if you're going to let it measure and manage you.